In this video, we're going to talk about leasing. Leasing is a way to acquire assets. But if we look at the fundamentals, right, look at basically what leasing is all about, right? Leasing is a form of debt, right? We're utilizing debt or a debt-like instrument to purchase an asset. So let's look at some terminology. The lessee, that's who uses the asset, right? They make lease or rental payments. So there is an expense associated with being a lessee, which is the lease payment. The lessor is the person that actually owns the asset and receives the rental payments. Now, so what's the difference? Why is this important at all? Well, it's important because if leasing is a form of debt, where does it show up, right? Does it show up as a liability for the lessee, right? So the idea is that sometimes this has been referred to as off-balance sheet accounting. That is, there are things that have happened in the business world that we just do not show on the balance sheet, but it definitely should be there. So the IRS has set up some rules, and that's what we're going to be talking about in the next several slides here. But the lease decision, again, is a financing decision, right? The lessee is trying to figure out how they can acquire this asset. They can either buy it or they can lease it. Now, for the lessor, right, the person who owns the asset, this is an investment decision for them. So what are the different types of lease arrangements, right? So we talk about something called an operating lease. These are usually short-term. They're normally cancelable, that you can cancel it sometime during the lease arrangement. Maintenance is usually included. So essentially, you get the asset, right? You obviously make the lease payments, but you don't have to pay to maintain the asset. It's included in the lease cost. Now, a financial lease, sometimes these are longer term, and they are normally non-cancelable. And typically, maintenance is usually not included. Now, from a outside viewer looking in, an operating lease is what we think about a lease being, right? You are using this asset for a certain period of time. At the end of the period of time, it goes back. A financial lease, though, frequently these are set up so that they really look like a loan. That at the end of the time frame, at the end of the lease, for some reason not for some reason, in the contract, there is a transfer of value of the asset to the lessee from the lessor. So it really looks like a loan. So these things, it's important to understand the difference so we understand how it affects the balance sheet and the income statement. A sale and leaseback is when a company owns the asset, and for some reason, most likely cash, they sell this asset to another company and then lease it back. Now, of course, when they lease it back as a lease, if it's an operating lease, which in these most likely it is, that company that we sold it to, they now maintain the asset. And of course, we have combination leases that they can make these a little bit more creative, if you will. A synthetic lease is something that looks like a lease. Maybe it's not exactly a lease. Again, these are all different types of leases. What we're mostly interested here is, number one, understanding how we analyze the difference between lease and buy so we can make a good decision. But the second thing then to understand is, how are we going to create this lease so that we get the kind of outcomes on our income statement and balance sheet that we want. So, again, how are leases treated for taxes? The IRS looks at these as either being guideline or non-guideline. A guideline is what we expect happening with an operational lease or an operating lease. The entire lease payment is deductible to the lessee. For a non-guideline lease, we're going to have to calculate an imputed interest payment that's deductible. Because in a non-guideline lease, essentially we book this asset as an asset. So we're going to depreciate it. So we're not going to be able to write off the entire lease and the interest, because we're going to write off the interest and then we're going to depreciate the asset. And again, why is this important? It's important because what shows up on the balance sheet as a liability or not. So for accounting purposes, again, we talk about leases are either capital or financial or operating. Again, capital leases and operating leases longer than a year must be shown directly on the lessee's balance sheet. Operating leases, sometimes also referred to as off-balance sheet financing, used to be disclosed only in the footnotes. Now, the rules are different, right? We have changed the rules so that now both kinds of leases are ultimately capitalized. They're placed into the balance sheet in a way so that the asset and the liabilities show up. So leasing is essentially a substitute for debt. So it uses up the company's debt capacity. Now, this is where the previous slide statement becomes important, because historically, this was an off-balance sheet item. So it didn't show up as debt. So that means it did not eat up into the debt capacity of the company, which put creditors at a disadvantage because there was a liability that was not booked as a liability. So here we have a company, right? They're going to get a 4-year lease that includes maintenance. And the IRS, this lease meets the guidelines, so we can expense it. So this is an operating lease. And the rental payment will be $260,000 at the beginning of each year. Now, of course, don't forget, we're going to have to include taxes when we do these calculations. The other information, though, is that we could buy this asset. It cost $1 million. The loan rate is at 10%. Tax rate's at 40%. It's a 3-year maker's life asset. If we borrow and we buy a 4-year maintenance contract, the contract's going to be $20,000 payable at the beginning of each year. And at the end of the time frame, there's going to be a residual value of $200,000. So the first thing we need to understand is a little bit about the depreciation shield, right? So every year, it's the depreciation expense times the lessee's tax rate. In this case, obviously, we have that 40% tax rate. So the very first year's depreciation is $333,000 odd. So the shield is that expense times the tax rate, $133,320. So let's see what the spreadsheet looks like for the cash flows of a lease. So here we have the after-tax loan payment, right? So it's the $100,000 times the tax rate. So that's the actual loan payment. The depreciation shield, we've calculated that. So once you calculate the depreciation expense for the asset, multiply that by 0.4, that's this depreciation shield. Now, we're all also, excuse me, we're going to, this is for the, for owning. This is if we own the asset. I apologize. So here's the loan payment. They told us it was 100,000. 60% of that, obviously, we're going to pay some taxes. Here's the depreciation shield. We're buying the maintenance agreement. Since we're buying this maintenance agreement, it's tax deductible, so that means there's a tax savings. Again, it's 40% of 20, right? So that gives us this $8. The residual value ends 200,000. 40% is the tax rate. So now we have a tax that we'll pay on that. So here's the net cash flows for owning this particular asset. So what does that ultimately mean then? Well, first of all, let's think about leasing in general, right? What discount rate do we want to use when we are talking about leasing, right? It's very similar to debt financing, right? Cash flows have relatively low risk, right? Usually it's fixed by contract, right? So then the 10% cost of debt for a company, or whatever the cost of debt is a relatively good candidate for the discount rate. Now, of course, interest is tax deductible, so the actual discount rate after taxes is 6%. So this is the discount we want to use when we're analyzing our leases, right? So it's the after-tax cost of debt for the company. So here we have, again, this cash flow stream for owning the project. What's the present value of that at 6%? And the answer, again, if you put this into a capital budgeting technique worksheet that we have, you would find that the discount rate 6%, then the net present value of this would be ultimately negative $591,000 odd dollars. So now what about the lease? We pay $260 a year on the lease. Of course, that's expense, so we have a tax savings. So here is the cash flow stream for a lease of this particular asset. So at 6%, this lease has a present value of leasing is negative 572. So we want to find out, is it better to lease the asset or buy the asset? So the term we're looking for is the net advantage to leasing. You take the present value of leasing and you subtract the present value of owning. So in this case, the present value of owning is a negative present value. So you take negative 572 minus negative 591, obviously it turns out to be a positive 18,000. So there is an advantage here to leasing. And if you just look at the two numbers, right, there is a cost, right? So what is the cost of leasing? Negative 572,000. What is the present value of owning? Negative 591. So you choose the one that has the least cost associated with it. So that's our beginning description, if you will, of leasing for a corporation. See you soon.